we bought four condos between the end of 2009 to mid 2011, and we were able to refinance those four at the end of 2011 at 70% loan to value, and we cashed out everything that we put in.
Right.
And we sold all of them in 2014, 15 after they doubled in value.
Nice.
Obviously, they were cash flowing from day one. So yeah, I mean, we made a good profits on that. But the main thing is that we learned that we don't only like the returns, we like the process.
Hmm.
We like the process, we like the industry, and that's what made us think that maybe we should make the shift from
Hmm.
what we're doing right now towards doing real estate full time.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? Scott Kidd, the Yacht Captain Investor Podcast. I have my friend here, Eliav Kling, another real estate investor. How you doing today, Eliav?
I'm doing great. Thank you for having me on the show, Scott.
Well, I'm really happy to have you here. We haven't caught up in a while. And for those that don't know you, tell us a little bit about yourself.
Sure. So I'm coming from the tech world. I've been in IT and the tech space for over 25 years. Started investing in real estate as a plan B for my wife and myself. And Plan B became Plan A in 2016 when both my wife and I quit our day jobs and became full-time real estate investors. That came after we invested in multiple properties by ourselves with our own capital, and friends and family around us started to ask questions how they can jump in. So
Nice.
we took a pause and we said, okay, let's jump right in, and we since then we're operating as a private equity real estate firm.
Nice. So that's really great. I mean, it's great that you've been in it for a while, so you've seen the roller coaster for quite some time, and you got in at the right time when things were starting to pick up again in 2016. And you were investing before that, naturally, correct?
Yeah, we started investing in 2004.
Oh,
Jumped into the U.S. market in 2009 after
oh,
the
time.
financial crisis.
Yeah.
It was a great time to get in. People told us that we're crazy, but you're buying condos for 50, 60,000 a door, and they're rented for 1,100 a month.
No brainer.
Yeah, it's a no-brainer.
Yeah. Well, I mean, that's, generally when people are telling you you're crazy, you're probably doing the right thing.
Yeah, I mean, people listen too much to the media.
Yeah.
They don't form their own opinion
Yeah.
based on the facts, and they don't have the right knowledge. So you cannot judge something if you don't have the knowledge around it.
Most definitely. You can't really take advice from someone that has never really done that before, because I know around that same time, 2007, 8, all the houses in Florida became worth half, some of them a third. And I asked a few people around, like, hey, what do you think about this? Let's put some money together and buy them. They're like, oh, no, 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 no. And then kind of listened to them. And that was to my detriment, because by the time I realized that hey, I should jump into this, it was already too late, because all those prices had been gone, and the houses were starting to be bought up by the larger groups, 20, 30, 100 at a time, which, it still took several years to sort out, 2012 till it started to kind of moderate.
Yeah, absolutely. We bought four condos between the end of 2009 to mid 2011, and we were able to refinance those four at the end of 2011 at 70% loan to value, and we cashed out everything that we put in.
Right.
And we sold all of them in 2014, 15 after they doubled in value.
Nice.
Obviously, they were cash flowing from day one. So yeah, I mean, we made a good profits on that. But what it the main thing is that we learned that we don't only like the returns, we like the process.
Mm-hmm.
We like the process, we like the industry, and that's what made us think that maybe we should make the shift from
Mm-hmm.
what we're doing right now towards doing real estate full time. And that's when we start to, well, actually, when we refinanced those condos, we thought, okay, what's next? We had like about $250,000 cash in our hands, and we wanted to move to the next level. For us, it was multifamily investing, but we knew very little about it.
Mm-hmm.
It's a as you
Different
know,
ball
it's a
game.
completely different space.
Yes.
Like the brokers are different, insurance is different, valuation is different, like loans are different.
The process is
And
different.
we understood that we don't know enough, and that's going back to the education and knowledge.
Mm-hmm.
So we actually started educating ourselves. We took a very extensive coaching program. We paid a lot of money for that, but it taught us on how to invest remotely from Canada in the U.S. market,
Nice.
in the multifamily space.
Excellent. I mean, what advice would you give to other people that are looking at getting into multifamily or commercial real estate that are looking to do that jump? Because I hear it a lot of times that people want to do it, but they just don't know what the next steps are.
So I think that there's basically three ways of doing it. You can learn it by yourself, maybe make some mistakes on the way, but it will take you longer to get to the same result. The second way is get coaching. So get the knowledge,
Yeah.
acquire the knowledge first, do a couple of deals by yourself before you involve any investors, because it's a serious overtake. I mean, it's a serious responsibility. And
Mm-hmm.
the third way is basically partnering with someone that has the experience, have done it multiple times, and can show that they have the track record. Uh, and when you join forces with someone like that, then you can make leap jumps. I think that those are the three ways. If you would ask me, probably the third one is the fastest way.
Yes.
Just partnering with someone that knows what they're doing and learn on the way.
Yeah,
Um,
it most definitely is. I know it's helped me immensely just putting myself around people that are much further ahead that know the knowledge, and I'm always learning anyway, and that's something that people need to realize as well. Once you think you know it all, I think you're going to get into trouble, because there's something's
Absolutely.
going to come out of there that is going to really hit you like a ton of bricks because it can be the best deal you've ever done, and it can be the most devastating one too if you don't get involved with the right people, and if you have to really be in alignment with all the people you're involved with because you have to realize that you're married to these people for 5 years, 7 years, maybe 10 years.
Absolutely. Partnerships could be devastating if you're not aligned on, I mean, first and foremost on the personal level.
Yes.
You have to be aligned on your core values. Forget about the deal. The deal
Yeah.
is secondary. But if you're not aligned in your core values, you're gonna have issues down the road. Like marriage, like you said. I mean, If
Yeah,
if you don't align, if you're not
most
aligned,
definitely. Yeah, most definitely. Because if you're getting into it just because it's a good deal, you're probably, well, more than likely you will end up in a lot of problems because a deal can be, um, can go great or can go really bad if you don't have the right people in there, and if you're not aligned with them, and like you said, get to know the people first. Like these people, one I'm comfortable with just being around because you will be around them quite a lot. Because if you're a general partner or a GP on a deal, it's not like where you're a limited partner where you put in the money and you're pretty much passive. General partner, you will be working with those guys. And what I've seen a lot with people when they go through some of these programs is that they're not told that the GP it's quite a bit of work
it is.
involved, no matter which part of the team you are, and what have you found that was new when you started getting into it?
So again, partnerships were always something that was a challenge for us because we
Mm-hmm.
we were not able to trust uh, too many people. Luckily, in the past year, we actually found our companions,
Nice.
and we have decided that we're going to join forces. The two companies, our company is Care Investments, and our partners is CSL Partners. And again, the first thing was getting to know them. So
Mm-hmm.
I know one of them. We know one of them for over 20 years, actually. We know
Perfect.
we know his parents. We're actually good friends with his parents. So we know the family. We know his values, and we got to know his partner. Um, and the first thing was to spend a few days with him and
Mm-hmm.
make sure that we are aligned on our values. And
Definitely.
only after that we said, okay, we're ready to call it a partnership, a true partnership, and move forward.
That's
Uh,
excellent. I
so
mean,
that's fundamental. I think that's fundamental with every,
yes. Yeah, that's
taking the time, spending a few days. Even when when you're looking at for properties or running even due diligence for a property, you get to know the person, and I think that's extremely important.
yes, it really is. It goes back to the relationship. And if you want to be, if you're in it like yourself for the long term, you have to be looking for those long-term relationships. And that's a big tip for everybody, is that you have to look for those long-term relationships. Because if you don't have long-term relationships, you won't have a long-term business. You'll be jumping from one thing to the next to the next, and you won't have consistency, and you probably won't build traction, and
Absolutely, yeah, it's very well said, Scott. I mean, I completely agree with that. It's harder to build long-term relationships.
yes,
Harder to find the right match,
yes,
but it's worthwhile because when you have this alignment, things
yes, start coming
they
together.
get much easier.
Yeah, sky's
Uh,
the limit when you find the right partners, because
Absolutely.
everybody's clicking and on the same page, and then things move. Actually, with having had all those patients to find that person, once that comes together, things start to move very rapidly, and you're able to execute and keep executing. Because a lot of people think once you get the deal and you close on it, oh yeah, we got it. Well, that's actually when
That's
all
only
the work
when you
begins.
start.
Yeah, that's only the beginning. You got to execute for your residents, especially in the multifamily, for your residents, for your investors, for your team, all the way through till it's full cycle, till you've sold it or you've refinanced multiple times. And you really have to have multiple exit strategies. And if you have a good team and good partners, you're able to do that. And if you need to pivot, you all go through all the motions of, hey, what's our best case? And communication is another big thing because if you have a good relationship, you guys are able to communicate to each other, And what would you say the communication style is with your teams that you're now involved with?
We're very casual. I mean, we have a WhatsApp group. If we need to jump on a call, we schedule that on WhatsApp and just jumping on a call. Sometimes you need that.
Yeah.
Obviously, we have our weekly calls and procedure on how to vet properties. But once we have something in motion, you have to react quickly. You cannot wait for the weekly call to discuss things.
No.
You
Yeah.
need to get things done.
Yeah. You have to be very proactive and kind of,
Yeah,
I would imagine once you guys have done a few deals together, you probably have kind of a template of processes and how and who's doing what and
exactly. Yeah,
how you
defining the roles
execute.
and responsibilities is critical.
Yeah. And then I would imagine there's some overlap. Sometimes some tasks are a little more intensive than others, and like, hey, I'm gonna need a little help with that because I'm pretty backed up with those things. There's some issues that came up as they always do in the due
Absolutely.
diligence or with the financing or equity partners and stuff like that. And would you say just from the last few years, and we were discussing this before, like how is it now, like raising capital now from and I imagine most of your capital comes from retail investors.
It's actually a mix. When we started, it was only retail investors. Started with friends and family and referrals, basically. Today, we're operating in the $20 to $50 million deals. So it's kind of a mix between retail investors, family offices, which is the
Here.
mid tier,
Yeah.
and also some institutional investors,
Equity groups and stuff like
depending
this.
on the deal. So you need to listen to your investors. You need to know what they're looking for
Yes.
and really understand their needs. Some retail investors, some not really, sorry, some of the institutional investors, they will not touch, a 70s deal.
Mm-hmm.
But on the other hand, there are some family offices
That
they
will.
they don't care about
Yeah.
the vintage. They care more about the deal, the risk, and the returns. So you need to know who to approach
Mm-hmm.
in every one of the deals, right? Retail investors, I'm trying to educate them as much as I can. I think it's part of our role as GPs, because they're the least. Most of them are like less sophisticated than
Yes.
ourselves for sure, but also from the family offices that are out there. So I'm also trying to educate, especially if it's a new investor that was just introduced to us. I'm trying to educate, make sure that they understand the risk profile, and what to expect, especially people that have invested in the stock markets.
Yes.
Now they need to understand the liquidity thing, right? It's
Yes.
real estate is not liquid.
Yes.
So they need to understand that. They need to appreciate that. They need to understand that there is nothing guaranteed.
Yes. It's the same thing with a lot of other things in life. Any investment in life is not guaranteed. Tomorrow's not promised. So, especially if people are used to the stock market where they can get things in and out really quickly, you have to be very specific in how you explain it. 'Cause I've gone through this before with other people with the liquidity issues. I had someone that had about $100,000, and I said, "Well, okay, is this all the money, your savings and everything?" And they said, "Well, I have some other." And I said, "Well, how much?" And we went through, and I said, "Is it so? This is basically your emergency fund. This is not something for you because if your kids get sick or something happens, you can't."
Yeah,
I won't be able to get you your money
you
out
don't
for
have
five
access to it.
years unless someone else buys you out, which is rare. because a lot of them are just like you, where they've put that money ahead and there's not really necessarily, so there's no guarantee there either where they can get their money out. Chances are the money is held for at least 5 to 7 years. With a
Exactly.
little bit of luck, maybe there's a refi event in there somewhere if everything is going extremely well. But chances are there won't be. So that person kind of got a little bit upset with me because they really wanted to learn and get into. I said, "Well, I'll show you everything that's going on, but I don't think this is the right thing. I don't. I wouldn't be do. I would be doing you a disservice if I took your money and something happened. And then they told me later on that they did have an event, something happened, and they said thank you because,
Yeah, listen, I'm
I
happy
said
that you
because
touched that because you've done the right thing.
yeah,
Done the right thing. Unfortunately, there's some other operators that are taking advantage of some of
yeah.
those
They'll take
uneducated
whatever. They'll take
investors.
whatever from
Uh,
whoever. And I don't think that's the right thing. I'm
no,
here to show people, for the most part, first and foremost, to educate people and know that, let them, like you said, so they know that these options and opportunities are an option and an opportunity for them. They don't necessarily have to invest with me or anybody else. But in my eyes, I didn't know that a lot of these things that existed some time ago. So, and it has really benefited me. So I want them to know that this is a possibility for you and this is an option. So, you know, if it's not now, it could be later. It doesn't have to be ever either, but you at least have to know that this is an option. And that person, I felt good about doing that because I would have hated, I wouldn't be able to sleep at night if that person had something going. I would have to try to figure out how to get them some money, and that wouldn't be the right thing either because it could become a very messy situation for that person. But you know, that person will probably tell other friends and people and referrals and stuff and tell them that I did the right thing and that I'm always going to be looking out for them. And I wouldn't be doing the right thing if I didn't, if I didn't do that. I couldn't sleep. And I know you couldn't either. That's why you have to, always walk that line of doing the right thing. And like you said, there are plenty of people out there in a lot of different industries that will just take whatever from whoever, and that's not necessarily that's not the way you want to be, and that's not the right thing to do.
no, and it stains the entire industry.
Yes, it
And
does.
it's going, what you just said, it's going back to the long-term relationships, right?
Yes.
Because when you hit someone like that, take their money and didn't explain what
Yeah.
the risks are, you're not going to form a long-term relationship with them.
No.
But when you explain and do what you just did, I mean, this guy will follow you and will be grateful for what
Mhm.
you've done for them for many, many years.
Yeah, and
So it's easier to operate that way rather
yeah.
than do it the wrong way and go
Yeah.
and keep chasing money.
Yeah, and if you're doing it, money is one thing. We all need it for certain things, but if you're doing anything just for the money, your life is going to be more than likely empty. You won't have any long-term relationships in your life, and your life will not be whole. That's a proven thing. Seen it many times with uber wealthy people and people that just chase the money, and usually they're left by themselves in the elder years of their life if they're lucky enough to live that long.
Yeah,
So it's not what I want to live. I'm not a very materialistic person, but I get excited about real estate, and I think it's for both of us. It's done a lot of great things, and we've been able to see a lot of opportunities that potentially other people don't know are possible. Which I think it's our job as people to show other people that these things are possible. So not necessarily they do real estate, but hey, maybe it'll inspire them to do other things or take that chance or step out of what they're doing and be uncomfortable and do something. So
100%,
yeah.
100%.
So what are you working on as of late for 2025? What do you see moving forward? You guys mantra as far as the two companies that you guys have combined with, or the one company?
We're underwriting a lot of properties. In some cases, prices are still unrealistic. Uh,
Yes.
People are asking very low cap rates, and that's okay. I mean, if someone is not forced to sell right now, I would do the same.
Yeah.
On the other hand, there are a lot of operators that bought deals in just after
2022.
COVID,
Yeah.
21, 22, when rates were extremely low. They bought it for I think stupid money,
Yeah. The Great
and we
Reset.
see some of those coming back right now
Hmm.
when the loan has expired, or even after that. Uh, we've discussed with some lenders that took over some properties, um, and they're struggling. They're struggling
Yes.
because the properties they're not worth even the loan that
Yeah.
was put on them. Um, so again, when you're not when you don't know what you're doing, and people groups they bought properties such low cap rates in
Hmm.
during those years, they didn't even think of underwriting it in a different manner. We when we underwrote deals in 21, 22, we added 2% to the loan
Yeah.
as a stress test to check if we could get a loan for 3%, we underwrote it at 5
Yeah.
to see if the property can actually hold a 5% loan, because we knew that those rates will not sustain themselves.
Yeah. Yeah. Because you were probably getting a 5-year loan or a 3-year loan with
Exactly. We knew
5-year
that in
balloon.
5 years, rates will not stay at
No.
3%. They have never
No.
been that low.
No.
So, yeah, did we lose deals? Yes. But I don't think that we lost. I think we actually gained.
No, I think you did the right thing. You gained. 'Cause I remember a couple of times I was talking to you. You said you guys had sold off a bunch of stuff, and then you were you had not found anything. Nothing is penciled for quite some time. You've put
Exactly.
in a bunch of offers, but things were not. But that's fine if somebody wants to pay $1 million, $2 million over. What I told somebody is like, well, we lost the deal. I was like, well, there's probably a reason why, and so. Probably what will happen in maybe 3 to 4 years when that loan resets, you probably have an opportunity to buy that maybe at a discount.
That's what we're seeing right now.
Yeah.
We're negotiating a few deals right now. One of them is actually firm and lender, and you know we can agree on a price, but it will be less than the loan.
Wow.
So they will their investors will have to absorb the heat, right?
So they'll probably lose most of their equity then, probably, right?
Well, the equity is
Gone.
completely wiped out.
Yeah.
The lender took over the property already.
Oh, yeah. So
So
that's gone. That's
even
gone.
even the even the investors that provided the capital for the lender,
Oh,
they're not going to see all their money back.
no, they won't.
So you know, people have done or took stupid decisions after COVID
Yeah.
in light of the low interest rates.
Yeah. And
They're
liquidity and the
Yeah, I mean,
liquidity in the
listen, it
market.
was very easy to look very sharp between
Yeah.
2018 and 2022.
Yeah.
I mean, the market went up. No matter what you did, you were making money.
Yeah.
But your good operators are measured not in the good times, but
In the
in the
bad
more
times.
challenging times.
And by their track record.
Exactly. So, well, for us, the most important or precious thing to us is our reputation.
Yes.
And we're not going to risk it for a deal.
Yeah.
Yeah, like
And
as good as it could look like on paper
on
or in
paper, yeah,
Excel.
and that's where your due diligence and everything else is probably very stringent, where you go in and stress test it because you knew that the rates weren't going to stay at 3% forever, so you did it at five, which 5 to 6 is the historical average.
Exactly.
So if you can get to that, then you refi there, then you're probably okay, and then you probably look through the previous history of the property and just the way the areas and everything are going, because things were a bit, for lack of a better word, a little bit wonky after COVID, where a lot of people had moved to a lot of places, and people also thought that maybe they were going to stay there, but then ended up a lot of people moved back. So
Yeah.
you kind of lost that population and that growth. So
Yeah. And some
it
areas were overbuilt.
yeah,
You need to take that into account because occupancy will drop when those units will be online.
yeah, we're seeing that
Um,
now for sure in some
yeah,
areas.
in some markets you can see that. Yeah,
Yeah. There's, Austin, I think, is one of them for sure.
absolutely.
The absorption hasn't caught up yet. I know there was a lot of stuff because we're developing in Dallas area, and a lot of stuff came online last year. But interesting enough, a lot of it was absorbed, and it was in the northern part of Dallas Fort Worth area. You're seeing a lot of stuff came online in Florida and Tampa, I believe, Orlando. Some of that got absorbed. It just depends because Florida's such a scattered market. There's
Yeah,
each little township has its own different microcosm. So that's a good point too, is that it's very local. It's so Dallas is a huge place. I mean,
yeah,
from the east, west, north, and south, and then you have Fort Worth, and then the in between cities, they're all different markets. So
100%. Yeah, you need to
do
know the market. You need to do your due diligence, do the analysis. Know what's going on, how many units
yeah,
are built,
yeah.
everything like that.
Know
It,
what's going on for the next few years.
yeah,
And this is very important too, is that you have to have boots on the ground. You have to have somebody there watching the store, because this is what I'm seeing a lot of now, is a lot of these properties that are being turned over to the banks and stuff. They thought they were being managed properly, but they really weren't. They had a third party property management, and no one was checking. So, when the loan comes to reset, they thought they were at 90% something percent occupancy. They were on paper, but the economic occupancy was in the 80s, so they couldn't refinance.
yeah,
They have to do evictions. Then the stress is much higher because now the loan is resetting and the bank doesn't want to refinance them because they were too far off. They have to
yeah.
do a capital call, and I'm seeing quite a bit more pref equity coming in as to take over the deal. I'm seeing that quite a bit. Are you seeing some of that in the markets where you are?
Yeah, we are seeing some of the deals that are looking for pref. We normally try to stay away from pref, and unless it's a very specific deal that it makes sense for that
Yeah,
specific deal. But it's going to be like that from the get-go.
yeah,
We also try to limit the loan to value to
that's good.
70%. We want to cap it normally at 70%. Again, unless it's a value add like a project, then it could go up to maybe 75%. But we don't want to be in the 80s and 90s,
Yes, over
just because
leverage.
it's the risk profile is completely different when
Yes,
when when you have it that way.
yes, the risk goes up quite a bit when you're taking on that much leverage. And that like you said, unless it's some kind of heavy value add or repositioning or something like that, uh, maybe. But I do like that that's another great tip, is 70% loan to value. Then you have that buffer to where if the prices do correct, rents maybe moderate or come down. then you can hold for longer because you have that extra buffer that you don't have to. You're not scrambling at 85%. It's probably going to go back to the bank, or the bank is going to want, yes, we will refinance for you, but you'll have to bring X amount to the table. So then where you're seeing a lot of capital calls and stuff like that. I'm seeing quite a few and hearing of some. Um, and there's a couple of people that asked me, what do you think about the capital call? And I said, well, and they wanted me to look at the deal that they had. And I said, well, I don't know enough about it, but the main thing you need to ask is what specifically are they using this capital for? Um, why do they need it? What is the situation right now that causes this? Is the money just going to pay out, get the loan to where they can pay out the GP team and the investors don't get anything? Or are you throwing good money after bad where this deal cannot be saved? You
That's a
have
very
to
good
see.
point. Yeah, I've seen deals where the GPs had a capital call and they're basically paying themselves,
Yeah.
which is again, it's the wrong
No,
thing.
that is a no. That's really poor. That's really bad. It's the wrong people to be involved with, because I have a deal that I'm a limited partner on an LP, and it's in Cleveland, and it's through a friend of mine, and Dave had a lot of operational kind of negatives that were unforeseen. Like the city, they were planning to redo a bunch of units, and then immediately it took a year plus before they could even touch any. The city brought in all these extra inspections that were new because it was a new council, new everything. So,
Yeah,
but it's now been 3 years or so, and actually longer, and actually close to getting to four. And we have not received any money, but the GP team has put their money in, and they're trying to save the deal. And they said, look, it's not a great situation, but we're working to get you guys your money back. And that's the worst case scenario. With a little bit more time, we're hoping we can turn things around. We now have,
that's what you want to see. I mean, you want to
yeah.
see GPs that are,
And
knowing
I
their
knew
skills and
from the
working.
relationship I had with this person that they're going to go to the mat. They're going to do all they can. And if we lose, I took the risk. And it sucks, but if we lose, but I know they did. They're working the best they can, which is what I would do. You're not going to just let it go. Well, that's it, and let it go. They put their own money in. They're doing their best they can because the timeline got pushed back even further. And then after the year and a half, when they started building, the prices had gone up.
Right.
It was during that heavy inflationary time. So then now they're having
The
to do all
cost.
these extra stuff. Then they couldn't find contract, and it was just, that just goes to show you that sometimes it's just one thing that happens and then it causes this
Exactly. You
snowball
don't you don't
effect.
have control over all the elements,
Yeah.
and that's the risk that
Hmm.
is involved when investing in real estate. Um,
Yeah.
as a GP, when we're underwriting a deal, every parameter that we're changing, we're asking ourselves, how will it impact the investors?
Yes.
Will it change the risk profile? And if
Yeah.
so, we need to go back to them and
Hmm.
explain the new risks that are
Yeah.
involved.
Yeah, if anything
Uh,
changes, you definitely have to communicate effectively, and that's another tip for people that are looking to invest in syndications is what's the GP team's communication style? Are they readily available in the beginning? Are they always able to explain to you what's going on? Do they
yeah,
do monthly reports, quarterly reports? Are they available to explain stuff to you? Because they should be you know um and that's very important because how they start with you is usually how they're going to continue to be with, and you want to make sure you're comfortable with the explanation, because it's a great way also if you want to become a GP is invest as a LP first, and get with a team like yours where you'll explain stuff and be available to talk to them about it. And then that way they know what more and more. And because it can be a pretty big learning curve of all the variables and stuff,
Yeah, absolutely.
it's very important that the GP team one takes care of the residents, because if you have happy residents, you're going to have happy investors, because the residents will stay, the investors will stay. They'll be happy because the returns will be there. Because if you have a fully occupied place that people love living and they're paying market rents, that's a well-oiled machine.
Yeah, absolutely. You take care of your tenants, it will show up in your financials.
Most definitely. So what's next as far as what areas are you guys focusing on? What markets?
We're currently focusing on the southeast, some from Texas to Florida through Georgia and the Carolinas are the main markets. From time to time, we'll underwrite deals in the Midwest, where in the Midwest traditionally the cap rates are slightly higher.
Yes.
Appreciation is more moderate, but the cash flow is higher.
Yeah, cash flow is good.
So it depends. Our buy box is, as I said, $20 to $50 million deals, 100 plus units, mid 80s normally or newer, in a B class or higher. It's pretty standard. We're not, we're not much different than any other groups.
Yeah.
It's
Are
just
you looking at a lot more stabilized deals or like value add, or are you looking for?
no. There must be a value add component. It doesn't have to be through renovations.
Can be okay.
It could be operational.
Mm-hmm.
For example, our latest Hialeah project, it's a brand new property, right? It was built in 22, 23.
Yes.
The upside over there is operational through some operational savings, primarily with the Live Local Act.
Oh, okay.
In Florida.
Yes.
So with that, we're going to save about $1 million a year on real estate taxes.
Nice.
So that $1 million translates into 18, $20 million in value.
Yeah, because you were probably since it's a Class A property, you're probably at a 5 cap or 4.5, 5.
We bought it at a higher, but even if it's a 6 cap, we're talking about roughly it's going to be between 5 and 6. So $18 million probably.
$18 million. Yeah, I've seen that quite often, is that after buildings that are fairly new, the builder has already, once they go to sell, they've kind of got their price they need to get already, and then the rents are probably a little bit lower. So then there's always that value add component, like you said, could be operational like that, where you just bump rents because it's a brand new building. There's some kinks to be worked out, but it's usually moderate. It's not very at best, and then you bump the rents and then they get the expense. The expenses are kind of moderate as well once they've
stabilized. Over there we were able to save on insurance about $180,000 a year.
Yeah.
So again, every dollar counts.
Yeah.
When you save money,
the cap rate makes that multiple even better.
Exactly. With a 5 cap, every dollar goes up, translates to $20 in value, right?
Yeah.
So you save $100,000.
$2 million.
It's $2 million in value.
Yeah.
So that's it's tedious. It's not sexy. But you have to be on top of your management, like property management team, as an asset manager.
Attention to detail. Yeah. It's exactly. Attention to details.
Attention to detail. Be creative. Come up with solutions, and don't wait.
Yeah. No, never wait. Always be proactive.
You need to act when things are happening.
Yeah. And what would you say? Do you meet with your property management team once a week? operations and stuff and go through everything. And no,
Yeah,
that's
with
great.
every property we go, we have a weekly meeting. We go on, everything that is going on, and obviously if there is a need, we'll have ad hoc calls during the week. But in all of our assets, it's a weekly call, uh, plus additional calls. If we need a special call for marketing, we'll
Yeah.
have a special
Lease
call
up
with the
or
marketing.
anything like
Exactly.
that.
Yeah.
Even events
We
at the
implement,
property.
yeah, if
Yeah.
we want to implement different technologies, it's going to be a separate call. But a weekly call as a basis, and on top of that, we'll add, ad
Yeah.
hoc.
Yeah. There's no such thing as passive investing when you're a general partner.
Definitely not. If you're passive, you
Yeah,
have
you
to be
will
on top
make
of
it
things. Things will go offside.
bad. Yeah, things will go really bad if you think you're hands off when you are a general partner. You will be in for a rude awakening because the problems that you neglect now will only become huge later on.
Yeah, exactly. I mean, when you aim again, you're coming from the sea world.
Yeah,
So one degree off
yeah. You
after
are hundreds
after
or
six
thousands of
after
miles
60
off.
miles, you're
Yeah,
1 mile off target, right?
yeah, yeah. That you're that far off
Yeah,
in X amount of hours, and it only gets worse.
exactly, exactly. So you have to do small corrections and keep on course to be able to execute your business plan.
Yeah, you definitely do. Well, this has been great, and it's really great catching up with you. For people that would like to find out more about what you're working on and more about your business, what's the best way for them to connect with you?
So either through our website, kara-investments.com, or find me on LinkedIn. It's
Excellent.
Eliav Kling on LinkedIn. Normally, I'm responding within less than 24 hours.
Yeah, and I can say that for a fact because he responds pretty quickly on LinkedIn.
Yeah,
Because we've
absolutely.
conversed quite a bit on LinkedIn. So, well, thank you so much for being here and taking the time to speak with us today, speak with me today. I really appreciate it.
Thank you very much, Scott. I appreciate the invite, and I think that you're doing great things on your end
Thank
as
you.
well.
I
So
really appreciate that coming
I
from you.
appreciate
That
you as a colleague,
yeah.
someone that is in the industry,
Well, thank
which
you
is
so
doing
much.
doing the right thing.
Thank you so much because I appreciate that coming from you. That means a lot. And I'm Scott Kidd. If you like the Yacht Captain Investor podcast, please like, subscribe, and share with your friends. And reach out to us if you'd like to learn more about what's going on in our world. And as always, as a reminder, investing in yourself is the best investment you will ever make. Thank you. Talk to you guys soon.